I do not see why that is not going to happen again, considering the evidence I've put to you. And a lot of you will be saying, yeah, but inflation is going to be higher. In 2008, inflation was at peak when they were cutting. Inflation is in the rear view mirror. Future inflation based on what's happening in 3 years' time, that's a whole different issue. Cyclical inflation is always lagging. Core inflation lags that even further. So if it's lagging and the forward-looking growth indicators are falling, then I think the probability is the Fed are not going to go as far as people think. Then the bond market's wildly fucking wrong. And the equity market is an enormous buy. And what becomes really interesting to me is, what do you buy here? Well, if I'm wrong, and we do get a bigger recession, which 2018 was forecasting but hadn't come, but let's say the recession comes. I don't think it probably comes till 2023. But if it does, well, markets usually fall in recessions 30%. That's kind of average over the last 30, 40, 50 years. But no recession had the power of the bank balance sheets, which we saw last time around. You basically lower the denominator. Right now, if they do QT, they're increasing the value of the denominator. No shit, equities go down because you've increased the value of the denominator. But I think the bigger move is the ongoing debasement of the denominator that will come in due course. What I think is the most important things for everybody to understand, this is my perspective. We're in an extraordinarily complex world right now where we're seeing supply shocks that we haven't seen since possibly World War II, or certainly since the 1970s. We've just had a pandemic and everybody's scrambling to figure out what the hell is going on. Where is this going? Are we going to get a recession? The issue right now is inflation. This is the thing that everybody's talking about and everybody's fearful of, is we've never seen inflation like this, well, not since the 1970s. So if you look at the chart of CPI now, you can see we're at levels of 8%, which is something we can't get our heads around in this apparently deflationary or disinflationary world. How did this happen? Was this the money printing? Now, I've talked at length about this in other Real Vision content and written a lot about it in Global Macro Investor and Macro Insiders. My view is that the persistent inflation of the 1970s that you can see on this chart was actually driven by demographics. When the baby boomers came into the population in the largest number in history of, let's say, 30-year-olds all buying their first house, first car, and everything else together, we had a demand shock. We also had supply shocks as well, from the Arab oil embargo in 73, 74, and then going into the Iran crisis in 79. So we had a double. We had a massive demand shock and a massive supply shock. This time around, I think it's different. This time around, we have a supply shock because essentially the pandemic had shut a lot of things down. So that was the supply shocks of trucking and moving goods around and manufacturing, and factories weren't open. And so you had to bid for higher prices to get stuff. And then there's the issue of underinvestment in commodities themselves. So what's happened is, as the world's reopened, we don't have enough ability to produce commodities at scale. Then we throw in the Russian crisis, the war in Ukraine, and we've taken commodities out of the market. It's created this very heady mix that is really scary right now for everybody. And that drives equities higher. And then we're in a tremendous technological period that I call the exponential age, where everything from AI to robotics to electrical generation to data to space to crypto, metaverse, all of this, biotech, genetics. I mean, it is an unbelievable time. The world has never lived through a period of time of Metcalfe's law adoption curves on top of Metcalfe's law adoption curves, creating Reed's law, which is a ridiculously powerful moment in time. We've got this aging population. It's creating tremendous fear because the rate of technological advance is so dramatic. We've never lived anything through it in such a short period of time. But you want to own that bloody stuff. You don't want to fear it. And I see people on Twitter all day. It's like, oh, Cathie Wood, these people are awful. Who wants to own a Tesla? You're fighting the biggest logarithmic trend we are ever going to see. That is the opportunity of a lifetime. So I want to be a buyer when I see that the inflation story goes away. I'm looking to buy growth. And in fact, I put out a trade recommendation in Global Macro Investor and in Macro Insiders about this by using a whole basket of these exponential names I've been following for 18 months. I haven't pulled the trigger on any of them before, including things like ARK, where I've said, let's average in over 8 weeks because I think the market might have this 2018 spike low, but I'm not sure. I don't have the visibility. And if we get a recession, what are the Fed going to do? Well, the Fed are going to print. And what does that do to these stocks? Well, real rates fall. Those stocks explode higher. So let's go back to my favorite log chart. Here's the log chart of Bitcoin. Bitcoin log chart using the regression channel. One standard deviation oversold. One standard deviation sold is as big an oversold as crypto as Bitcoin ever gets. So we should be buyers, not sellers. I mean, could it go lower? Possibly. Probability, no. So I think you should be a buyer and seller. We're looking for this inflection point of this, maybe the ETF, maybe the ETH 2.0 staking. That's going to change the dynamic of this market. And if inflation numbers are falling and growth is falling, you want to own crypto. Long duration assets. Here's the log chart of Bitcoin, just the recent price action. It's just sideways. Nothing's happened. I love a sideways consolidation. Sideways consolidations lead to explosive upside. Now, does it go lower, hit the bottom of the channel? Probably, possibly. Don't know, don't care. Because I'm in this trade for the long run, because the long run, you need to ride the exponential log channel. And I prefer ETH than Bitcoin because here's the ETH Bitcoin cross. It's a running flag. And normally that resolves with an upside break. So we should see a significant outperformance of ETH over Bitcoin over time. And it's been doing that in recent times, even as Bitcoin sold off. And I'm going to talk you through why I think that we are at peak inflation fears and the world is about to change towards low growth and inflation coming down and what that might mean to you, your portfolio, the economy, and to asset markets. So the next chart I've got is the year-on-year rate of change. Everything in financial markets is about rate of change. It's not levels. Now, the rate of change of inflation is still going up, but commodity inflation has been going down and fast for a period of time. That will feed through to CPI. So this is the all commodities year on year. But one of the things we've been talking about is food commodities. So the food commodity chart, people have been talking about global food shortages. And I don't really have time in this piece because it's going to take a lot of time to get through what I've got to get through. But that's not 100% dyed in the wool. I'm going to be speaking to people like Dwight Anderson to figure out, okay, how scary is the food situation? Could we end up with global food shortages? We're going to end up with some shortage for sure. A lot is going to depend on this harvest in the West and also whether they use food as a weapon against Russia or not, or whether foodstuffs can continue to flow as they did even when we had the Cold War with Russia. People really don't want to create this food situation, but we've got problems with fertilizers, all sorts of stuff. But the year-on-year rate of change is coming down. And that means that CPI is going to come down. Doesn't mean your food price is going to get cheaper, but it means the rate of change becomes less shocking.